let's take a look here at Disney. Iconic company, obviously. So, couple of the quick stats. Walt Disney Company is the official name. Symbol is DIS. Trades at about $84 per share, and it's a $153 billion market cap. So, first thing I really want to note about Disney. Well, the first thing I'll note about actually just being a recent visitor to the Disney parks is that they have a fantastic ability to separate people from their money. And I can speak to that firsthand. Um, and people are doing that with a smile on their face. So you really have to respect a company that has an iconic brand that everybody is aware of, that is able to do such a fantastic job of making people go broke and happy to do it. But aside from that, when we're just looking at the company from a investment perspective, from a financial analysis perspective, first thing is I like to break a company down and figure out, what do they do in all segments of their business and how do they make money. And one thing I will say about Disney here is that it is a very complex company. So I broke it down into a segmented tree just to kind of like show a few of the segments that exist in Disney. I could actually break it down way further than what I did, but if you take the overall company, Walt Disney, that you could break that down into two large segments. The two main segments are Disney Media and Entertainment Distribution. So this is 63% of revenue for the first 9 months of the year. And then the other key segment is Disney Parks, Experiences, and Products, which is 37% of revenue. So looking at that first segment, Disney Media and Entertainment, that further gets broken down into three other segments, which include linear networks. This is more of their cable business, their cable investments. There's direct to consumer, so this is their streaming services. So Disney Plus, ESPN Plus, Hulu, and then there's content sales and licensing. And then when we go back to the other key segment, Disney Parks, Experiences, and Products, that is further separated down into parks and experiences and consumer products. And I could keep segmenting these as well. It's really like a rabbit hole. It's quite a complicated business and very diversified in terms of the different things that they do. Looking at the share price performance, as much as I respect their ability to come up with ways to separate people from their money, share price performance has not been great. Looking over the last year, it's come down from $112 to about $84 per share. Now, when we look at a long-term chart on Disney, the stock is actually trading right now at a 9-year low. It hit a peak in around 2021, March of 2021, at about $185, and now at $84. It's basically seen almost nothing but a dive from that peak. So what's happening here? It's at a 9-year low. Does that mean that it offers tremendous value? We got to get in right now. What is causing this massive share price volatility? So there's a lot of speculation and opinions out there in the market. Some people think that because there's some political baggage with Disney, if you follow, there's an ongoing battle war, so to speak, between Disney and the governor's office, DeSantis's office in Florida. They're trading back and forth. Some people think it's gone too woke, and that's why the share price has not done well. But there's a few different things here. So I'm going to say that I don't think that the political issues really have much to do with this. I think that a lot of it really just boils down to the company fundamentals. And then as well, a few other things that drove the share price to a range in 2021 that it never really should have achieved in the first place. So when we look at the company's all-time high of about $185, we have to keep in mind that this was during the peak of the pandemic craze. So there were some absolutely wild valuations at that point in time. And I think that the main thing that was driving Disney's stock price at the time, well, there was actually two things. One, we were opening up from the pandemic, which meant the parks were opening back up, the cruise lines were opening back up. So people were expecting, obviously a lot of financial improvement there. But then there was also Disney Plus as well. So Disney's streaming service and how it was competing with Netflix. Streaming was a huge tension on the streaming company business during the pandemic. I mean, it still is, obviously, but during the pandemic, there's a lot of tensions. And if you look at Netflix's stock price, it really actually demonstrated the same behavior as Disney's. Right around that time, March of 2021, it had hit an absolutely insane high. and then it subsequently just basically fell off. Now it fell much lower on a percentage basis than Disney, and has since recovered. Different businesses, but I think that a lot of what people were looking at the time was Disney Plus, and how it was gaining market share relative to Netflix, and this was really adding to the valuation. Since that period of time, that pandemic craze, valuations across the market, in some cases, while still high, have really returned to more reasonable levels. And I think that a lot of what we've seen in terms of the share price decline from Disney is more related to that. It never really should have gotten up to that price. There is nothing justifying a price, in my opinion, of 185 per share. But let's take a look at the recent financial results from the company for the quarter. Their fiscal Q3 revenues were up 4%. Operating income was about flat, and adjusted EPS was down 6%. For the 9-month period, revenues were up 8%, operating income down 6%, and adjusted EPS was down 9%. So really, we're not seeing anything very spectacular in the financial performance from Disney right now. There's some areas of the business that are performing better than others. When we go look back at the Disney Plus business, I mean, I'm a Disney Plus subscriber, so that's another way they're able to separate me from my money. I think it's a very good service. I 100% have plans to continue it, but it is not a profitable part of the business. It was expected to lose money for about 5 years, and I think now we're getting at a point where over the next 1 to 2 years, they're focused on generating profitability from Disney Plus. So that could be a major driver, a positive driver for the company in the future, but it hasn't happened yet. So let's wait to see signs that it's actually going to happen before we get too excited. We'll take a look here at the company's balance sheet. They have about 36 billion in net debt. So relative to their equity, that's a pretty good debt to equity ratio. Relative to their EBITDA, net debt to EBITDA of 3.6 times. For a company like Disney, it's a very capital intensive business. They have cruise lines, they have the parks, they have studios, filming studios. It's not what I would consider to be an unacceptably high leverage ratio by any means, but it's certainly not low. I mean, I would not want to see it much higher than what it is. So I would at the very least say that Disney is a fully leveraged company at this point in time. In terms of what analysts are expecting going forward from the company, so for the current year, analysts are expecting a very moderate amount of growth. The consensus estimate is about 372 in earnings per share, and that would put the valuation at about 23 times earnings. So certainly, given the share price performance, or the financial performance rather, that we've seen, the balance sheet, the 23 times is not what I would consider necessarily incredibly overvalued, but it's also not what I would consider necessarily very attractive. Now, analysts are expecting big growth in earnings per share in 2024. The consensus is 492. This would drop the price to earnings ratio down to about 17 times. So much more attractive valuation. And then there's that expected growth in 2024. But I would just say, let's wait and see. I think that analysts have made, if memory serves, some assessments of Disney that have not come true. Expectations have been pushed forward. So rather than just look at that 2024 figure, I would, and assume that it's actually going to be achieved, I would look at it with some skepticism at this point in time. If they are able to achieve that, and most other factors with the market are, reasonably healthy, then I think that the company is set up for good share price appreciation. But I would also be very hesitant to just accept it. One thing that I would definitely say with Disney is if you look at the trailing earnings per share. So I'm just going to look at this from a GAAP basis, not adjusted earnings, but just GAAP earnings per share. There's not really been certainly a consistent uptrend in earnings over time. And in fact, earnings really peaked in the pre-pandemic era, and they have not fully recovered since. Now, again, these are not adjusted earnings. If we were to look at adjusted earnings, it's probably about $4 in 2023. So certainly the picture looks better, but we're not getting a consistent growth and profitability per share, which is what we really like to see from a company. So certainly there's some good reasons to understand why the stock right now would be trading at a multi-year low. And just to sum this up, I really like Disney. I like it as a company, being a customer. As a stock, I think that it does have some potential being an iconic brand. That it does have sticky revenue. The valuation is okay, and there should be a good long term growth opportunity, which includes the potential for profit additions from Disney Plus. But the earnings performance really has been lackluster. The balance sheet leverage it's okay, but it's fully levered company. It's not low leverage, and as well, I mean, this is a high ticket consumer cyclical company, so it is by no means insulated from a recession. Long term, I think that this branding, the iconic brand, is going to be a great asset, continue to be a great asset that produces substantial cash flow. But if we do enter into recession, the company can experience some challenges. So I don't see a reason that I would recommend this as a stock investment in the near term. What I'd be looking for is a clear improvement in profitability. And I do think that there is a long term investment potentially into the brand. So if people were interested in Disney and they wanted to take a very small position at this point in time, I wouldn't argue with them. But it also wouldn't surprise me if we saw more downside on the stock. And I'm certainly just not seeing a clear investment thesis on why somebody would want to rush into the stock right now, or why it offers fantastic value. So we continue to be on the sidelines with Disney, and we'll just see what happens over the next couple of quarters.
Yeah, it's interesting with Disney too. Part of them now, it is a different environment now, but if you look at their box office releases, the movies they've released over this year, certainly haven't done as well as what you've seen historically. Like if you look at releases this year: Guardians of the Galaxy, The Little Mermaid, Ant-Man and Wasp, Indiana Jones. Just for comparison purposes, if you look at like their highest grossing movie this year, Guardians of the Galaxy Volume 3 is about 844 million worldwide. Sounds like a big number, but if you go back to 2019, Avengers Endgame did 2.78 billion. Star Wars Force Awakens did 2 billion. Like Avengers Infinity Wars did 2 billion. So like really on the list right now, it's 35, number 35 of the movies they've released. So you're seeing uh, you're not seeing comparable numbers at the box office for some of these movies. They're not hitting it out of the park. So you're not seeing some of the windfall profits you can get from those movies if they really hit. Now, it is a different scenario now. Back in 2019, they didn't really have Disney Plus. So you know, people are now, instead of going out to and watching it at the box office or watching it at your theater, you can grab the movie a couple months later, a month later, or you can even wait and get it streaming several months later as part of your package. So I am sure some of the audience is just saying, let's take a pause. We'll watch the movie in 3 months, and you're not watching it at the movie theater. But still, when you look at those numbers, you can see it is a significant decline. They haven't hit it out of the park with any movies in terms of box office receipts over the past several years. Certainly not in 2023.
Another interesting thing that recently they did, or Disney's ESPN ended up striking a deal with Penn Entertainment, I believe, where they're actually planning on launching a sports betting, or jointly launching a sports betting business together. And from my understanding, so under the terms, Penn will pay ESPN about 1.5 billion in cash and offer about 500 million worth of warrants to purchase its shares, blah, 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 blah. Either way, it's interesting just to see, the company is partnering with Penn to essentially, launch a sports betting app, which is becoming
sports and gaming are just interlinked now. Like it's become,
they sure are.
It's crazy how it's become.
And of course that was so topical because Penn ended up, cutting its ties with Barstool Sports, and basically just giving the business back to Dave Portnoy, who I'm sure many of our listeners have heard about. And decided to go with ESPN, which is probably the better route.
It's certainly a bigger brand, more sport, and a different audience is watching all across ESPN than is watching just Portnoy's boys.
Exactly. Portnoy's boys on
Barstool.
Exactly.
Yeah. Anyways, interesting for sure. And those like sports and betting is just intertwined twined right now. I know my dad, every time he watches sports, he curses it down. What is this gambling every time I have to
Oh,
see? But like, there's so many people that, it adds juice to the game. That's, I want
my
to do.
friends, man, it's
Yeah.
crazy. It's
Lunatics,
like
right?
it drives me nuts. It's like if you spent any bit of time building a portfolio, rather than speculating on sport.
Fantasy leagues and
Anyways,
gambling. Yeah.